Good evening, everybody. This is Howard Friend. Welcome to my weekly webinar on trading and technical analysis techniques. This week I'm going to be talking about one of my own proprietary trading setups called the false break of resistance and the false break of support, or FBR and FBS for short. The idea is to capture moves at the turning point, to look for a market trap. So my theory is that many of the big moves in the markets that one as a trader would like to capitalize on to make money from tends to occur after a false breakout of some kind. I call these setups market traps. So traps are formed when traders are caught on the wrong side of the market. Most often they form after a technical move, for example, a break of a support resistance level, a support level or a resistance level, but often they have a fundamental trigger, i.e. a piece of news. So I've developed a methodology which I call break and retrace, which helps me identify and capitalize on market traps. So break and retrace works like this. This is the bullish, the buy example. So the price starts off at roughly an equilibrium point. We get a break through a support level, or a piece of news comes out and the market makes a sharp break lower. So we get a very sudden move to the downside. Now, most of the time after a break move, the market goes sideways for a bit and then it continues in the direction of the break move. But what I'm looking for is for the market to start to retrace higher and then go all the way back up to the point of origin of the breakdown. So at that point we know that all of the sellers on or after the break move are trapped, they're underwater, they're losing money, and it's their buying covering their short positions which is going to drive the market higher like this. So with regards to technical or chart based traps, the break move occurs when we get a break below a support level or a break above a resistance level. So technical theory has it that if a support level goes, then the market is likely to continue to fall because demand at the level at which the support came in at has dried up. So the market falls to a lower equilibrium level. The same thing can be said about the break of a resistance level. Market breaks up, breaks through a resistance level, so there are no more sellers at that level, and then demand is obviously greater than supply and the price goes to a higher equilibrium level. So that's the basic theory of market price action. But with the trap situation, with break and retrace, if the move fails to see significant follow through buying or selling, then those who bought or sold on or after the break will start to exit their positions, and that's when we start to get the retrace. So if all of the break move has been completely retraced, then a trap is said to have been formed, and then we can look for a big move in the opposite direction to that of the break. So how does the false break of resistance work? Well, false break of resistance is basically a trap for the buyers. It's basically a bull trap, if you will. So it's in terms of which way the market is likely to go, essentially what we're looking for is buyers to come in on the break of a resistance level with the expectation of seeing higher prices. But if that move doesn't materialize, then they will start to exit their long positions, and then we'll start to see the retrace and the trap could form. So what happens with support and resistance levels on the charts? Traders use support and resistance levels. They can place their stops there because obviously if you happen to be long the market, if you've bought the market and it breaks through a support point, then the market is likely to continue to fall. So that's why traders place their stops on the other side of support or resistance levels. So you can imagine when the market's moving up and down, we're getting the formation of support and resistance levels all the time. So when traders enter the market, they need somewhere to place a stop loss on their current position. And if the market goes through that point, then suddenly there's supply or demand hitting the market. So with regards to the false break of resistance, there's an expectation when the market breaks through a resistance level that it should go higher because supply has exhausted itself at that point, so the bulls are in control and the market is going higher. It should go higher. And so people are buying into it looking with the expectation of higher prices. But if that move stalls and then starts to reverse, then we find that the people who bought the breakout are starting to lose money. So it'll be those people who will be exiting their losing long positions, and then we start to see the market retrace to fall back. Once we get to the point of origin, we can expect a big decline to the downside as the longs are bailing out. So from a trading perspective, this is an opportunity to attack the market from the short side, to be sellers. This is essentially what the false breaker resistance pattern setup looks like. So what we've got here is the market starts off by trending higher, usually forming a series of thrust bars where the close is above the previous bar's high, typical bullish price action. And then we get a little bit of profit taking kick in. So after a few of these thrust bars, the market reverses, the longs start to take profits, and we start to see a bit of a correction. This is normal price action within a bull market. So after the correction, buyers come back in and they have another go at the upside. Now usually once the market breaks through this resistance level, the swing high, there's an expectation that the market should continue to go higher. So repeating this kind of action that we saw before the pullback. But in this case, the false breaker resistance, once the market breaks through, if it fails to sustain that breakthrough, then we start to see nervous break buyers, people who bought the break above this red line, start to sell the market. And push comes to shove as the market starts to break down here through the low of the up bar, the new high bar. And then we can expect the move to the downside. That's a trading opportunity for the short sellers. Okay, so let's see a few examples of false breaker resistance in action. Now, false breaker resistance and false breaker support, they work well on charts of most time frames and charts of different markets. So I'm going to show you a whole bunch of examples on anything from intraday charts out to monthly charts on a variety of markets. So first up, we've got euro dollar. This is a weekly chart of euro dollar going back several years. So what we've got here, this is a bullish phase. So the market starts off with this big double thrust, two consecutive thrust bars to the upside, and then we get a little correction of that move, and then the bulls start to take the market to higher highs and higher lows. So nice typical bull market action, higher highs and higher lows. Then we get to this point here, this red line just above the 150 level. The market sees a pullback, and as with previous pullbacks within this bullish trend, buyers come back in after the pullback. They push the market up to a new high, but on this occasion we break through the red line, we do not close above it. On the next bar we get another push back up through this red line, but by the end of the bar the market is sharply lower. It's much lower than the red line, and it's much lower than the previous closing price, weekly close. So this is a good indication that the buyers are starting to lose control of this market. They've had a good run up to now, but now we get to the point where the last buyers are coming into the market, and it's really not built on solid foundations. So as we start to break down through some of these lows here, then we start to see some aggressive selling, and before you know it, the market is in a bearish phase. So having this piece of information, knowing that the market has broken through a resistance level and then retraced back and then started to break lower, it tells you something about positioning of this particular market, that we shouldn't be buying the market. In fact, we should be selling the market. Okay, here's another example. This is dollar yen, daily chart of dollar yen. So we start off with the market oscillating, going up, coming down, going up and coming down, and then coming up again. So a bit of price range action. And then at this point we get this big break to the upside. So this is a really bullish day. These are daily bars. So the bulls are really in control of the market at this time. So market pulls back, buyers come back in. This old resistance level is acting as support. Buyers come back in and they push it up to the new high. Now, on this particular day, we close above the red line. So this is looking really good at this time for a continuation of this bullish trend. But unfortunately for the buyers at this point, the next day the market starts to sell off. So at this point, the people who bought the break above this red line, they're starting to get a little bit nervous. Next day the market starts to break down, and then before you know it, we start to see the market selling off fairly sharply. So that's all these kind of buyers that are bailing out of losing long positions. We get an attempt at retesting the highs, but this move fails, bit of a head and shoulder type pattern there. The move fails and then starts to break down, and before you know it, we're in a downtrend. So having this piece of information again, that the market broke through a resistance level, this one, the swing high, failed to sustain that move, and then started to break through support levels on the way down. So good information if you happen to be a short seller of dollar yen. Moving on to dollar Canada, dollar CAD. We've got a situation, there are actually two good opportunities of false break of resistance, FBR, on this daily chart. The market starts off by basing out here, powerful move to the upside, nice little correction. The buyers come back in after the correction, push the market up to a new high through the red line, closes marginally below it. Next bar, they push it up higher again, but this time we get some real selling. They slam it down, and by the close, we're back below the red line significantly. Next day, there's another attempt at pushing above, and again, the sellers are coming out as the market breaks above this red line. So there's real supply coming out, and that's the people who sport the break of this high, who are getting out of losing long positions. And that's enough to provide a trading opportunity for the shorts for this move down. So 1, 2, 3, 4 days down, enough to make money on the short side if you're a day trader or if you're a multi-day swing trader. Market bases out and then starts to trend higher, making higher highs and higher lows. Same kind of situation here. So the market ramps up here, forms a swing high. We get some profit taking, but again, the underlying psychology is still bullish, just like it was back here. Buyers come back in, they push it through the red line, they push it through the swing high. This time we close above the swing high, so that at this point it looks like a valid breakout. This is looking really good for the bulls at this particular time. But next day, in come the sellers. We get this move lower, breaking through the low of this breakout bar. So at this point we know that all of the buyers above this high are trapped. They're trapped above the swing high, the red line. We get a retest here that they try to take it back up, get rescued, but that rescue doesn't really help. And on this day we get a reversal day, so the market breaks up, closes quite weak, and then next couple of days we start to see the market break down. So again, just like this was another good opportunity to attack the market from the short side. Excuse me. Okay, moving on to euro dollar, but this time a 15-minute chart. So basically a setup for spot or day traders. So what we got here is euro dollar moving sideways in the late European, early US session. We get a break through the swing high, the resistance level here in around 3:30 or so, 3 o'clock, 3:30 Central European time. Breakthrough, but by the end of that particular 15-minute bar, the market is back under the red line. So they pushed it through resistance, but the sellers came in and drove it down on that particular bar. So that's a bit of a warning if you happen to be bullish on this time frame for euro dollar. Next bar, the market breaks down through the low, and then we start to see the market sell off quite aggressively into the European close. So again, a push through a resistance level, failure, and then the market starts to go the other way. So these are good opportunities no matter what kind of time frame you are looking at. Okay, so that's a few examples of the false break of resistance. Now we're going to talk about the opposite, the false break of support. So this is the bullish example where the market breaks through a support level, fails to sustain that break, and then springs higher, providing an opportunity to make money on the long side of the market. So it's a bullish setup. It's known as a bear trap. So the bears come in, they sell the market, and they get trapped. So it's a bullish setup. So what we have here is the market breaking through a support level. And of course, when you break through a support level, there is an expectation of lower prices, because obviously if you break a support level, then demand at that level has dried up, and then the sellers are in control of the market. The market should continue to go lower. but what if it doesn't? And that's what we're looking for here. Traders place sell stops below the support levels on charts, and so naturally when the market breaks through a support level, you can imagine a lot of new trades coming into the market, people who are long getting stopped out, and also people who don't have a position who are selling short. They're taking new short positions on. So as I mentioned, the breakout through a support level usually sees follow through selling as a continuation of the downtrend, but if this move stalls and starts to reverse, then we see that the sellers of the breakout are starting to lose money. And that's what's going to be the driving force for the market to go higher. It's an opportunity to make money on the long side of the market by buying the market. Here's the idealized example of what I've just mentioned. So in a downtrend, the market is breaking down. We often see several of these thrust bars where the close is below the previous bar's low, several, maybe 2 or 3 in a row sometimes. The market then sees a bit of short covering, a bit of a corrective bounce, and after that corrective bounce, because the underlying trend and sentiment is still negative, the sellers come back in and they take the market down to new lows. Now, as I say, usually when the market breaks through a support level, there's an expectation that the market will continue to break down. And that's why people protect themselves, long traders protect themselves with stop losses below these levels. And that's why short sellers come in on the break of the level. But if the market then starts to go higher, then we see that the sellers of the breakout are starting to lose money. They'll get nervous, they'll cover their losing short positions, they're buying back what they sold, and then the market has got potential to go up, sometimes quite significantly. So let's see a few examples of false break of support. Okay, first up is cable, sterling dollar, weekly chart. And on this chart, I've got 3 examples of false break of support. So first one, the market is breaking down here. See the market pushing lower. Then we get a big bounce up, so it's quite a nice buying wave. Then as the market comes back down again, we get this very marginal new low where the market just takes out the support level marginally. But by the close of the week, this is a weekly bar, the market settles significantly above the red line, the swing low. Next bar, the market starts to break higher, and that's the short sellers stopping themselves out, buying back their losing short positions. Before you know it, cable is in a multi-week uptrend. So we get this powerful move up. Don't forget these are weekly bars. These are some quite big moves in real terms. So after topping out, then we get a bit of a selling wave, a bit of a bounce, another selling wave, another bounce, and then we get this push down through the support level. So here's the support level. The market breaks through it on this bar, but by the end of the bar closes significantly above it. So again, we've got sellers of this breakout, all these people that were selling short on this bar right here. By the time the market is up here at the end of the session, the weekly session, they realize they're on the wrong side of the market. They're trapped effectively below this red line. Next bar, the market starts to break higher. We get a bit of a retest of the downside, but this turns out to be a really bullish outside weekly pattern, which often forms a significant high or low in the market. From this point onwards, the market entered another multi-week uptrend. So again, having this information that the sellers had trapped themselves on this breakout gave way to a nice bullish advance from which you could have made money on the long side of the market. Okay, in this case, after this aggressive move higher, we get a reversal bar, then cable starts to trend down. Boom, boom, bit of a double thrust to the downside, correction higher after double thrust, and then the market breaks down again, makes the new low, again breaking through support, this time closes below it, so looking quite bearish on the close. Next bar pushes lower, but again closes just marginally below the line, and on this next week they make a marginal new low for the trend, but this ends up in a bullish outside weekly pattern just like this one, and that's the bottom of the market. So that was the last chance for the bears to get out of losing short positions. And from this point onwards, there was no mercy for the bears. The market rallied very, very aggressively, sharply from this point onwards. Okay, moving across to euro dollar, this time a daily chart. So we start off with euro dollar topping out around 115.5, 16 or so. We see this big wave to the downside, then a bit of a correction, then it gravitates back down, and then we start to see this break of support, and the market is breaking lower. So all looking very bearish. Market bounces back up and sees some more selling. Don't forget the trend is still down, and this selling wave takes the market down to the new low. But in this case, what happens is on this day, the market breaks through the red line, swing low, but closes back above it. That's the first warning sign for the bears. On the next day, the market starts to push higher, breaks through the top of this bar, and then we start to see some aggressive buying, short covering first, and then some genuine buying coming in. Look at the size of these ranges. And that's the bottom of the market. So again, knowing that we've had a break of a support level which has failed, false break of support, gives us a good idea who is in control of this market, and to trade on the side of the winner, basically. That's what you need to do as a trader. You need to think, who is in control of this market? What is the path of least resistance? In this case, it's pretty clear when the market breaks through a support level and fails to close below it and starts to move higher, it's pretty clear who's in control of this market. Certainly not the sellers. Okay, moving across to euro dollar yen, this time a 240-minute chart, just to show you the same kind of idea. You see the market trending down. It's a bear market, lower highs and lower lows all the way down to this point. So we get this mini bounce here off of the swing low, bit of a push down, and then here we break through the swing low. But by the end of the bar, the 240-minute bar, the market is settling, closing significantly above the red line, way above the previous session's close. And then that tells you that the sellers, all these people, are trapped. They're trapped underneath this support level. And it's their buying, covering their short positions, that's going to help drive this market higher. And that's what we get when the market starts to break higher after seeing this push down through the swing low. So you can see that false break of support and false break of resistance can get you into new trends at a very early stage, just by monitoring what happens when the market breaks through a key level, a support level or a resistance level. In this case, the market, after doing the reversal, started to break higher, big double thrust there, pull back, aggressive move higher. So certainly lots of opportunity to attack the market from the long side here. Another example, this is Euro Yen weekly. We start off with Euro Yen in a downtrend. We get this kind of range, a break of the range to the downside, and then we get this downtrend. Powerful move to the upside, and then that runs out of steam. Another attempt at the downside, breaks through support, bounces back up. That's the first warning. Next bar, breaks again through support and through the previous swing low, but at this time the market closes back above again, a bit like the last time, and then on the next bar we start to see the market breaking higher. So again, we've got a trap situation where we've had a false break of support right down here, and it tells you who is in control of the market for Euro Yen. From this point onwards, Euro Yen rallied, corrected back, and then we started to see a really good mega move to the upside, which was quite a good one to attack. Okay, so that's the false break of support. Let's just show you a few examples of both of the patterns on the same charts. Okay, so first up, we've got dollar yen, a weekly chart of dollar yen. We've got an example of the false break of resistance to start off with. Dollar yen starts off in this trading range, so down and up and down and up, just going nowhere really, nowhere fast. And then we get this push through the resistance line here. So on this bar we get the break through the resistance line but close back below it. So that's the first indication that this move could fail. On the next bar we then start to see the breakdown. So the buyers of this red line on this bar are starting to get a bit nervous, sell out of their long positions. Before you know it, we start to see dollar yen break down, and then we start to develop quite an aggressive downtrend with a bit of a gap in the middle as well, which is quite unusual for weekly bar charts. So after basing out down here, we get a powerful short squeeze which hits resistance just ahead of the gap. Then the sellers come back in, they drive it down, and this is where we get the trap. We get the push through the support level, close below it. Everyone looks, all the sellers are quite happy, looking pretty bearish. But on the next week, the market then starts to break higher, breaking through the top of this breakout bar right here, and that's the signal basically that the bears have lost control of the market. The market rallies quite aggressively from there, and then having broken through this resistance level, the market then runs out of steam and then starts to break down. So we've got a trap on the downside and then a trap on the upside. So this is a bullish trap and that's a bearish trap. So an opportunity to trade from the short side of the market for the next few bars. Now this is an interesting one. This is Dow Jones monthly. So I mentioned before that these patterns work quite well on various markets and covering all sorts of time frames from intraday out to monthly. So what we've got here is basically the top of the 2007-8 or so bull market and the bottom of the 2008-9 bear market. So what we have is the market trending higher. So higher highs and higher lows, all very bullish. And then we get this push through the resistance line right there. But by the close of the month, the market is below it. So we've got this little trap here where the buyers bought the breakout, but they couldn't sustain it on the closing basis. Next month comes along and then they start to bail out, breaking through support. And that's the top of the market. That gets you in ahead of the bear market which followed. Then the things got quite ugly at this point here. We've got the great financial crisis kicking off. The market bounces here. Then we get the push through the swing low, so all still quite bearish. We close below the swing low, but then on this month, when the market actually did its reversal, we get a break to the downside, but by the end of the month, the market closes back above the red line, significantly above the previous close. That tells you that the bears have lost control of the market, just like the bulls lost control of the market up here. So that's your sell, that's your buy. Okay, back to currencies, euro dollar daily. Another couple of examples here. Euro dollar is rallying, making higher highs and higher lows. Forms a swing high, then the buyers come back in, they push it up, breaks through the swing high, the red line, closes above, looking bullish, but on the next bar we start to see the market sell off. So buyers of the breakout are starting to get a bit nervous at this point because the market is not going the way they wanted. Next bar we start to break down through support levels, and then we find ourselves in a bear market. Market sells off quite aggressively here. We get the bounce. Sellers come back in after the bounce, drive it to the new low, breaks through support, but again the market breaks through, but by the end of the day the market is back above the red line. So the sellers of the red line, of the swing low, of the support level, at the close of this bar are now losing money. That's the whole point of this trading setup. It's just one of those things with markets. The markets, they go in one direction, people get overextended, it goes in the other direction, we get overextension on the downside, and that's just the way the markets behave. So if you're trading, you're looking to take advantage of this kind of habit that the market has. Okay, on to dollar Swiss, daily chart of dollar Swiss. This one starts off with a nice buying wave, then a pullback, and we settle into a bit of a range like this, trading range. Then the buyers come back in, they push it through the resistance line, red line, but failure, reversal, and before you know it, the market is in a crash mode, basically, falling very, very sharply. So again, break, retrace, a good opportunity to attack the market from the short side, looking for breakdown. So at this point, the market gets quite overextended, and we get this big, powerful snapback. But as the trend is still down, the sellers come back in after the snapback, and then we start to see the market dribble back down towards the swing low. Break through the swing low, marginal break of the swing low, bit like the marginal break of the swing high here, but by the end of the session, the market is significantly above the red line. So again, the sellers of this breakout are losing money as the market bounces back above it. Then within a couple of bars, we find ourselves in a nice bullish phase. So another opportunity, in this case, to attack it from the short side, in this case, to attack it from the long side. Moving on to cable, market breaks down, finds support, breaks the support, but next bar breaks higher, opportunity to buy the market, up it goes. We get this market tops out and then starts to trend down. Market goes into a range, breaks through the bottom of the range, the support level, but fails to significantly follow through. And then we get this bullish outside day, lower than the previous days, high greater than the previous days, and in this case, close above previous day's high. So in no shape or form is this market looking bullish, bearish at this stage. Then the market then starts to really rally quite aggressively to the upside. So again, the false break of support, an opportunity to buy the market. This move tops out here, goes into a range, another push to the upside, pulls back, another push to the upside, but this time we get the failure. Breaks through, closes below. Breaks through, closes below. Sellers are coming in on the break above the swing high. Then the market then starts to break to the downside, and that's the top of the market. Okay, so that's the theory of how the pattern works. So the next thing is to decide how to use these patterns, setups to your advantage when it comes to trading. So the first thing to do, and we're talking first of all about the sell situation, the bearish setup, the false break of resistance, is number one, we need to identify a swing high on the chart. And when I say swing high, I'm talking about a high with a certain number of bars to the left of it and a certain number of bars to the right of it with lower levels. And this is known as the left and the right strength. So a swing high is a high which is higher than n bars to the left and n bars to the right. Once we've found a good swing high, we draw a horizontal line to denote resistance. That's the R for resistance. Then we're waiting for a retest of this swing high, and if we get the retest of the swing high, the bar on which we break through it is known as the new high bar, marked NH. Then we get ready to sell. We're going to sell if the market breaks through the low point of the NH bar, and that's what we're going to do. So if we do break through the low of the NH bar, then a short position is triggered. We want to protect ourselves with a buy stop, and we place that above the high of the NH bar. We could use a tighter money management stop if that bar is particularly big. And it's always good to enter in 3 units to allow for partial profit taking. So that's what I do with most of my strategies and algorithmic trading strategies, is I divide the position that I enter into 3 units so I can take profits at different levels, because nobody really knows where the market is going to reverse when it goes in your favor, or any time, to be fair. So once in a position, the stop loss is there, usually above the high, the swing high. We put our limit orders at PT1, PT2, sometimes I'll use PT3 as well, so we know in advance where we're going to take our profits if the market goes in our favor. And as we hit each PT level, we're going to lower the stop loss, locking in profits and reducing risk. I always use a time-based exit as well, because most of these strategies are based on momentum, and momentum can reverse very, very quickly, as you've seen. So the idea is to get into the trade and to hold that trade for a certain number of bars or days or whatever chart you're looking at, and to get out no matter what after so many days or bars. Okay, so this is kind of the graphical representation of the setup. So the market starts off by moving higher, pulling back from a swing high and leaving behind a swing high, a resistance level. That's where we draw our line. Break through the resistance level, that's the NH bar. At the close of this bar, that is known as the NH bar, the new high bar. We've broken through the resistance level. Now, we place our order to sell short, but just below the low of this bar. And if we do go short, we want to put a stop loss ideally above the high of this NH bar. So that's our risk level. So the high of the NH bar minus the low of the NH bar is our kind of risk amount. Then we have profit targets down below where we place our limit orders to cover our winning positions if the market goes our way. As the market breaks down, if it breaks down, we hit PT1, we buy back one of our 3 units, and then we lower the stop, we trail it to break even. Same when we hit PT2, we lower it again from break even to PT1, and then we hope that we hit PT3 if we're using PT3, or we get out on the time-based exit. So that's the sell setup. So the buy setup obviously is the same thing, but in reverse. So first thing we need to do is identify a good swing low with good left and right strength. So a swing low is a low which is lower than so many bars to the left and lower than so many bars to the right. We draw a horizontal line to denote the support level, and then we wait for a retest of that swing low, and if we do get it, at the end of that bar, we mark it as an NL bar, a new low bar. We can then draw a line at the highest point of that bar, and then we get ready to buy. We put our buy stop just above the high of that bar. So a buy stop for 3 units just above the high of the NL bar. If we go long, we put a sell stop below the low of that bar, so our risk is the range of that bar. Could use a tighter money management stop if that distance is particularly big. And we enter long in 3 units so that we can allow for partial profit taking. So the idea is to buy and to have at least 2 targets, maybe 3, so that if the market goes as we expect, then we can say, okay, that's where we're going to take profits on 1 unit, that's where we're going to take profits on the 2nd unit. As the market breaks up, hitting the profit targets, we can then trail the stop higher. As I said before with the short example, always like to exit the trade after so many bars because momentum can reverse very quickly. Okay, so here's how the false break of support setup looks like. So we start off with the market breaking down and then bouncing. So we see this kind of support level or swing low set up. So this is a swing low. We're counting from once the market starts to top out here, we can count so many bars to the left, so many bars to the right. So the strength of the swing low is the number of bars to the right and number of bars to the left that the low is below. Once we break through the swing low, then we have a NL bar. We place our buy stop at just above the high of that bar, and then we put a stop loss. If we go long, we'll put a stop loss usually below the low of the NL bar. We go long, we have our targets 1 and 2, sometimes PT3 as well, and also we're using a time-based exit to get us out after so many bars in the trade. So as we break up, hopefully, we buy 3 units at the trigger, we sell 1 unit at PT1, we can move the stop up to break even. So if the market then falls back down from PT1 to our entry price, we simply get out of the trade. We don't make any money on the other 2/3 of the position, but we've made a little bit of money on the first third of the position. If the trade continues to go in our favor, we sell another unit at PT2, and then we can move the stop up to PT1, and so on. Okay, so in kind of conclusion on the setups, false break of resistance and false break of support patterns are seen at many important turning points as I've shown you. We've seen some pretty big ones there for major markets like the Dow Jones and some of the currency markets. And as I say, the pattern you'll see on all kinds of markets across all kinds of time frames, and it's something that you can use in conjunction with other indicators. You could use divergence, which often kicks in when we get these patterns. We get the market make the false break of resistance with bearish divergence on some of the oscillators. There are many things that you can use in conjunction with these setups, or you could use them completely standalone with the blinkers on, if you will. I find it's quite good to use these things completely on their own, because you can confuse yourself quite a lot if you're putting too many things onto a chart. But sometimes you can figure out if the market is making a false break of resistance or support. You know very well that there's very likely to be strong divergences on a momentum oscillator. So it's quite a good setup, and it can get you into some very good trends at a very early phase, long before you get the traditional turning point that you see, the reversal signal on, for example, a price pattern. So many of these false break of supports and resistances come from double tops, or eventually they form double tops or double bottoms, or head and shoulders, or whatever it be. But by using false break of support or resistance, you're actually getting in much earlier than the trend-based trader. You're getting in literally on the first real sign that that a trend is running out of steam. So if you happen to be a contrarian trader, in other words, a trader who likes to sell when the market goes up and buy when the market goes down, looking for a snapback, and many traders do this. Not every trader is a trend follower or a swing trader that trades only in the direction of the trend. There are many traders who like to trade markets that are overextended. But my argument really is, don't blindly sell into a market just because it's rising sharply, because ultimately the reason that markets are rising sharply is usually because there are more buyers than sellers, and that move could continue. Nobody really knows when the market is going to stop rising. There are many clues that we can glean from technical analysis and markets in general about where markets could top out or base out, but at the end of the day, the market is the market. It's a bit of an auction process. The market goes higher, people want to buy more, and you get this kind of self-fulfilling prophecy in some respects. So if you happen to be a contrarian trader looking to sell the market because it's expensive, my argument is, don't sell it just because the price is high. Sell it when you get some evidence that the market is running out of steam. And that's what FBR and FBS tell you. So a false break of resistance will tell you that the market that was previously bullish, positive, is showing clear signs that it's running out of steam. And that's what you need to make a trade, or at least some evidence to make a trade against the trend. So as I mentioned, FBR and FBS are valid on all time frames and markets, or most of them at least. As with all of the patterns and indicators and things, I would say these things work better on the beyond the day things than they do on the intraday charts. So daily charts are great, weekly charts are quite good as well. Some of the longer term time frames on the intraday charts, they work quite good, like maybe 1 or 2 hour and 4 hourly charts. I think once you get into the sort of 5, 10, 15 minute charts, then maybe the setups are perhaps not quite as good as the longer term ones. But having said that, if you are waiting for a particular signal based on other factors, then why not use a false break of resistance or support on a 15-minute chart, for example, if it's in the direction of the trade that you are looking to take. Okay, so I'm going to wrap it up there. Are there any questions on the setup? No questions at this precise moment in time? Okay, I think it's quite a lot of material to cover in the time frame. So there may be quite a lot in there, and it might need a bit of digestion for those that are not familiar with my concepts. You're not going to find these in most of the technical analysis books. A lot of this stuff is based on observations that I've made over many years. Yeah, if anybody has any questions, if not now, then as always, please feel free to talk to your CFI representative. They're always very happy to pass on any questions from readers, from viewers directly to me. Alternatively, I'm on LinkedIn. If you want to find me on LinkedIn, I'm always very happy to answer any questions or even discuss some of the products and services which I offer as well. I do trading education one-to-one. I do algorithmic trading strategies. I do trade mentoring. So lots of different products and services that I do. So be very happy to discuss any of those with you. So if there are no questions at this point, I will say thank you very much for attending. I look forward to presenting to you all again very soon. I believe next week we're taking a bit of a break, but we'll be coming up with a new schedule in the very near future. So keep your eyes on the CFI website where you'll get all of the forthcoming webinars. Thanks very much for participating, and the best of health and the best of luck.